We have Sam Chan from BDO is here, and he is going to, we're going to have a little conversation around startup valuations. This was coming out of our seminar we did in February that was run by one of the other partners in the valuations area, Daniel Ma. From there, we did have a lot of questions from our members, and we've continued to field questions around sort of the valuations and how do you look at startup valuations, which is extremely difficult at the early stage. And so Sam is here to kind of walk through a little bit of how BDO looks at that. So Sam, welcome. How are you doing today?
Good, how are you?
Doing well, thanks. Sam, I'm going to turn it over to you. And if you want to introduce yourself and your background, and then we can go into the presentation a bit, and we'll keep some time for Q&A.
Okay, perfect. Thanks, Galen. Good afternoon, everyone. And my name is Sam. I'm a manager in the Valuations group. Just to give you a very brief background about me, I've been with the Valuations group for about 3 years now. And basically, within the time, it's most of the valuations that we've been doing are across kind of all sectors, but primarily, I think in recent years, the focus has been obviously with tech and with startup valuation, with all the attention that, everyone is focusing on the technology valuation space. So in today's agenda, what we'll go through is sort of the 3 main valuation approaches that we typically employ at BDO in valuing startup companies, and I guess, and I guess with all companies in general, and also focus on some of the primary qualitative factors that should be considered and how these factors can be incorporated into the valuations approach. And just a little bit about BDO in general. We have a national presence with over 200 teams across Canada. In 2019, we've completed over 1,600 valuations. Most of them are in the deals and transactions space, followed by compliance, so tax and financial reporting, and with the rest in litigation and dispute. So as I mentioned before, some of our key areas of focus include financial services, technology, manufacturing, education, retail, and real estate. And sort of before, I guess, we dive into sort of the main content, what I want to do is sort of take a step back to discuss why it's important to have a valuation. I think both from the perspective of the entrepreneur and the investor. So obviously, from the entrepreneur's perspective, the fear is always, giving too much and receiving too little. And this is also a main concern because it also sets a precedent for future rounds of financing, as it can set an anchor to future negotiations. On the flip side, you do have the investor worrying that there's too much consideration given and not enough taken for the equity that's received. The investor is always concerned that the return on investment won't be attractive as what the entrepreneur originally pitched, but also somewhat mitigate that we have sort of equity investments or performance incentive of the entrepreneur, so they do have some skin in the game to kind of mitigate that risk. But I guess ultimately, sort of the main takeaway here is just knowing how important establishing a valuation is for the company and for all of the stakeholders involved. So hopefully, I guess by the end of this presentation, there'll be some additional clarity surrounding the process and maybe to give you better insight on this topic. So there are really 3 main approaches that we use to value any business. So the way I like to think about it is that before we do any valuations and try to land on a particular value, we need to take aim by selecting the right approach. And coincidentally, these are the acronyms for different types of approaches: the asset approach, the income approach, as well as the market approach. And we'll go through these in detail in the next couple of slides. There might be a little bit of information overload, but we have sent the deck over to Galen, which he can circulate to everyone afterwards. Okay, so with the asset approach, as you know, so the premise behind the asset approach is quite simple. What it suggests is that the company is simply the sum of its assets residing on the balance sheet less the sum of its liabilities. However, there are still challenges with this approach with respect to startups, because a lot of the startups are expecting somewhat high growth or somewhat hockey stick growth in its earnings. Because this approach doesn't really consider or the earnings growth, this could lead to an undervaluation in the business. As well, the startups may also have internally generated intangibles that's not included as part of the valuation. So think about the IP that it may have developed or the customer leads it may have under its belt. So these wouldn't necessarily show up on the balance sheet, and therefore the value could be overlooked. So often what we might do is to add in the value of the startup expenses. So for example, the costs incurred to develop technology, if it was expensed, and the costs spent on marketing or building brand awareness and customer list. So from a practice standpoint, what we usually, when we usually use the asset approach, it's usually for a very, very early stage startup company. Typically, it would be at a phase where they're not at the point where the technology is developed yet to be monetized, and there's still quite a bit or another milestone to go before the technology can be deployed or can be commercialized. So from our perspective, why we're looking at the asset approach is that it kind of establishes a floor value for your valuation. So at least the cost of incurring engineers or capitalizing costs and equipment, that would establish some sort of floor value. So this would be, I guess, a good data point to kind of triangulate the value that you have in mind. So the second approach that we're going to talk about is the market approach. So the idea here is that you can determine the value of a specific company by looking at other similar businesses. So typically the data for similar comparable companies can be found through one of two ways. So it's either through a comparable company analysis or a comparable transaction analysis. So for the comparable company analysis, this is where we look at companies that are publicly traded. And because they're publicly traded, these companies are valued on a daily basis and can provide useful information. So the second method is the comparable transaction analysis. This is where we look at recent transactions for purchases and sales of similar companies. And this also includes if there is information about recent financing rounds related to the company or related to, comparable companies. So this information for the transaction analysis is typically a bit more difficult to find because some of the data set can be private, but it can be quite useful as part of the data set. But in the startup space, most companies are private, so this data set could be more comparable as we're no longer comparing to large public companies. So once we found a listing of comparable companies or comparable transactions, we're trying to determine the value as a multiple of certain key metrics. So for example, what's the value over a revenue multiple or a earnings multiple? Then we can apply this multiple to the company to arrive at our value conclusion. So just a little bit of expanding on the topic of market-based valuations. So what I've got compiled here is sort of the median public company multiples for some of the larger public companies listed below. I do want to mention that these multiples have a high range and high variability that we have to adjust when we're arriving at the selected median. So typically for our practice, because of the high variability, we use a market-based valuation as more of a secondary check against our main valuation approach, unless the transaction data or the comparable company data is really, really comparable to the startup that we're looking at. So from my experience, what's typically relied upon would be typically private market transactions or recent financing rounds as a start to the valuation multiple. But As I mentioned, so there are challenges with this approach as well, and this is why we're using it as a secondary approach. So startups tend to be quite specific or quite niche in their value proposition, so it may not be that straightforward to find any comparables. And if you're trying to find relevant comparables, the typical metrics we use might not be relevant. So for example, revenue multiples or earnings multiples aren't that helpful if the startup we're valuing is pre-revenue or is not at a profitable stage yet. So you may have to look at other key revenue drivers and form a multiple on those drivers. So for example, with a e-commerce company, you might want to look at converted website traffic over the enterprise value of the business. So I think the main takeaway, I guess I just wanted to say here is that there's sort of a great variability in sort of the risk profile, size, and scope of the operations. So market-based valuations aren't typically used as the primary approach because it doesn't really capture the nuances of the company. But I think if we are to use it, we just need to be aware of the inherent differences. So for what I mentioned before in terms of size and scope or the growth trajectory of the business to really apply the multiples on an apples to apples basis. So the last approach here that I'm going to discuss is sort of the income approach. So the income approach suggests that the asset or the business is equal to the present value of the projected future cash flows. So in sort of a more simple terms, what we're thinking of when valuing a company is how much you would pay today for the right to receive all the earnings and of the company until the end of time or in perpetuity. So to employ this approach, it's basically, I would say, divided into sort of two components here. The first is sort of the cash flow projections of the business. So with startups, you're building this forecast out. It's important to map out the key revenue drivers. So rather than, pulling numbers out of thin air, the valuation would have a lot more credibility or credence if we can have some cooperation or if we can substantiate the numbers behind it. So for example, instead of, having a guesstimate that, the business will generate 1 million next year and then just targeting an X% rate of growth, maybe you're looking at the business that has signed contracts for future sales. So maybe the business can generate a certain amount of website traffic and expects a reasonable conversion rate and understand the pricing of its products. So if we take the latter approach and sort of build up what the revenue drivers are and sort of what the industry conditions are as well, then we can have a better understanding of what's driving the revenue as opposed to pegging it to some sort of arbitrary number. So I think back in June, my colleague Daniel Ma went through a business modeling presentation that provides an overview of sort of the key drivers into the main types of revenues, expenses incurred by company. So I think it's critical to have an understanding of those drivers, which definitely helps to provide a more robust projection and reduce the forecast risk associated with those projections. So the second kind of component within the income-based approach is the discount rate. So the discount rate is a measure of risk. So obviously the higher the risk in the forecast, the higher the discount rate and the lower the valuation. So in the startup space, we would expect discount rates anywhere between 30 to 70%, as these are typically the rates of return expected by early stage investors. So with the huge return and the huge range, the reality is that most startups will not be as successful as they originally kind of projected. So these investors are looking to hopefully make a massive return on one company to offset all the others that are not as successful. So in terms of the range, the 30 to 70% discount rate, the rationale behind that is that there's a lot of qualitative and quantitative factors that are considered. And this is something we'll go over in the next couple of slides for the income-based valuation. So I guess to determine whether the discount rate should be on the lower end of the range or higher end of the range, we generally consider four main factors. So these are sort of the quality of the management, the market or the market in which the business operates, or the industry, any financial history and stage of life of the company. So I think with the management team, I think it's fairly straightforward. So if there's one thing to remember is that, we should love the management team as much as you love the idea. So, a great idea is great, but, it's hard for it to come into fruition without the backing of a strong management team. So these are typically the questions that I guess we would ask when we're kind of assessing sort of the discount rate in our valuation. So what are the experiences and competencies of the management team? Have they assembled a team to cover the skill set required to meet the next target milestone? So for example, if they're creating an app, but they hired an outside engineer, so would that sort of be a red flag to you? Are there gaps in the workforce? So if the team's not complete, so are they planning to close the gap? Or I guess, how are they planning to close the gap? The next kind of consideration is the market or the industry. So the size and the trendiness of the market and that the company operates in is also a major consideration. So obviously, the larger the market, the more likely the valuation would be higher. Some of the questions we typically ask and try to understand is, is the market size large enough for the business to be feasible? Do trends indicate that the market size will continue expanding? And, does the market have appetite for it? Does the business exist in a acquisitive market? So, if there's potential for the company to be acquired by a larger one. And finally, it's just, I think it's your, I guess, expertise and how comfortable you are with the market that you're investing in. So valuations may also be influenced a lot by what's hot or popular at this stage. So if you recall, maybe even just last year, a couple of years back, the terms about blockchain and cannabis companies were really popular, which led to inflated valuations a while back as well. So one of the last components is financial information. So we discussed the projections and the cash flows in the slides before, but what we want to look at is sort of like the quality of the financial information. So, some things to consider are, what are the key drivers of revenue and earnings growth? And, are the revenues recurring, or do new customers need to be acquired every year? That would obviously affect, the risk and the discount rate that's used. The third thing is, liquidity, how much, what's the cash burn rate? And if you're investing, is there going to be enough cash to make it to the next milestone? Also, maybe another factor to consider is, how organized the financial records are. We want to be able to see, how the company is performing at specific points in time, and we want to make sure that this record is compiled on a timely basis. So the last point to consider is also the stage of the company. So if you're dealing with the extremely early startup stage and there's not a lot of financial information available, you probably need to rely on more of the qualitative factors, such as strength of the management team and the market in which the business operates. So the opposite is true for a company with a little bit more history. So the earlier stage the company, the higher the risk as well. Generally we recognize that earlier stage companies probably have a further timeline from an eventual exit, meaning that they're further away from realizing that the 10x return on investment, meaning that there's more time for things to possibly go wrong, and therefore there's more additional risk that needs to be baked into the discount rate. So with that being said, I just want to summarize kind of the major kind of takeaway points when we're evaluating companies. So these are kind of like the 6 sort of categories that we look at when we're having discussions with the startup valuations. So, one thing is the business model. Is it easy to understand and can it be articulated easily, right? We want the entrepreneur to have a clear vision of what ideas they have and what he or she wants to do and how to get there. Somewhat related to this is like management. What's the background of the management team in terms of experience, competencies, and knowledge? The target market or the industry, what's the total addressable market and how's that going to be captured? So will the market share erode with the entrance of new competitors or established competitors? Projections. So are the projections available to forecast future revenue, and what are the revenue drivers? Financials. We want to make sure, how much liquidity and how much cash is in the business for it to reach the next milestone. And finally, the implied valuation. So circling back on sort of the market approach, I think when we're doing the valuation, we typically have a preliminary idea of what we think the multiple is going to be. And then maybe another thing to consider is like if there's a difference between what the entrepreneur is proposing in terms of the valuation and what you have in mind, what are the differences and how can we reconcile that difference to the proposed terms? So that's it for the presentation. So if you have any questions, I'd be happy to answer them here now.
Yeah, Sam, that was fantastic. And if there's any indication by the number of chat messages we got and people even pinging me via email while that was happening, saying they want a copy of this. So I think there were a lot of people very interested in what you had to say there. So I think some great information. So if the floor is open, if anybody does have any questions, if they'd like to ask them directly to Sam, just raise your hand and I'll unmute you, or you can put something in the Q&A. One of the ones, Sam, from my side, you guys obviously provide this as a service. What would you charge a startup to help them establish their valuation? What would be sort of the benchmark that BDO would charge for that? Is it different by stage, or is there sort of a set amount that you guys charge people for that?
So that's a good question, because I think we typically have sort of standard rates that we would charge for the valuations. But obviously with the startup, cash is kind of critical to the business, and we understand that the cash could be sometimes be better invested somewhere else. So it really depends on the stage of the company. Obviously, I think when it's a very early startup, we recognize, they have limited resources versus, a startup at a later stage. And I mean, even with the startups at a later stage, we recognize that there's a lot more nuances and complexities with the valuation as it kind of grows bigger. So I think to answer your question, I think we start off with kind of like what we set as sort of our standard fee. And then I think based on the specific sort of like business case or circumstance, then we'd be adjusting it based on, the circumstances that, the client is in and the stage of the business. And, if there's any additional complexities with the business. Yeah.
All right. And then I'll flip that around, because we actually have a number of members that are part of small funds, or have their own venture funds and things like that. So if someone were coming to you and asking you to help them run through some valuation models for potential investments, do you guys have sort of set fees around what that would be?
We again, I guess we don't have a set fee of what that would be, because I think we typically have a range first, and then we would sort of, I guess, get to understand what the situation is and what they need the valuation for, and any sort of like complexity surrounding it. Because sometimes we do get valuations of startup companies because it's for tax purposes, or if it's for a upcoming financing round or something. The use of that is very different, and the risk associated with the valuation is very different as well. So I think that kind of factors into it as well. So it really depends.
Okay, and then I'm assuming that you guys are doing a fair number of valuations, probably on a global level. Do you guys share information globally around these kind of things? And the reason I'm asking that is, and going back to the investor side,
Yeah.
that I would assume that the more you guys are doing, the better the ability for you to be able to do comparables, and there'd be some cost efficiencies in that, but also that you would have a better data set to be able to compare against. Would that be a true? I know I'm leading the witness, but is that a true statement?
Yeah, like I mean, that I definitely agree with that as well. And I do want to mention, yeah, there's a lot of cross collaboration happening. I think mainly in the North American sort of region. So within the partners and the team members in Canada and the US, just because of like, you know, the location. But I think we do try to, you know, have some facilitation or training or some sort of discussions around the different sort of markets around the world, just to understand, you know, what's going on with the environment there and what are the trends, and also be able to refer, you know, clients to that contact if there's a valuation that they need for a company that's in the UK or something like that, as an example.
Okay, it was a very thorough discussion. I think you covered a bunch of the points that our investors were obviously looking for. And again, based on the fact that a lot of them are asking for the presentation, it is a really good sign that that people saw this as a lot of value in what you're presenting. And I think also helping us to understand what BDO brings to the table in order to help us and to help our startups as well. So again, Sam, I really appreciate your time. This was excellent information. And if other questions do bubble up, we'll make sure that we pass them along to you as well with this, okay?
Okay, sounds good. Thanks, everyone.
Fantastic. All right. Thank you very much, Sam.